All right, in this video, we are going to provide transparency around whole life insurance, specifically on the topic of how loan interest works. How does it build up over time? Let's have some fun. So when it comes to a whole life insurance policy, a beautiful feature is that you can borrow against it. For example, if you have a policy with $100,000 in cash value, you have access to that cash value anytime. Let's assume, for the sake of this example, you take a $50,000 loan. When you take that $50,000 loan, a lot of people aren't aware of this, the insurance company will continue to credit you a dividend, say it's 6% in this example, as if you still had the full $100,000 in cash value. Meaning, I've got 100K, I borrow $50,000, but I still earn that 6% dividend on the full $100,000. What I like to relate this to is if I have a home, a piece of property that's appreciating at 5%, if I take a line of credit against that property, if I borrow against it, I'm going to have a cost to borrow that goes where? To the bank, to the lender. However, if the fair market value of that property continues to appreciate, it's still in the entire property value, not just the remaining equity. That's how a whole life insurance policy works with respect to loans. So, on that point, when it comes to the loan interest, which is the purpose of this video, how does that work? So you take this $50,000 loan, 5% loan interest, we're going to assume for this example. Often you'll find it lower on newer policies issued from 2022 onward. But at 5%, if that's the loan rate you have of $50,000, that equals what? $2,500. If you validate that real quick, because I was the kid in school who always appreciated it when someone would go through all of the details. 5% of $50,000 is $2,500. Okay, so I took out that $50,000 loan. I've got $50,000 remaining in equity. How does this $2,500 actually build up over time? That's my question if I'm the policyholder, if I'm you. So the terminology that the insurance company uses, that the industry really uses, is that loan interest accrues on a daily basis, and the method used is annual simple interest. So when you borrow against your policy, the loan interest accrues daily at annual simple interest. Make sense? Probably not. It didn't for me the first time I heard it. I was like, okay. And then I went and researched it and rehearsed it a million times. When I say rehearsed it, I researched it so I could understand it and then rehearsed it in explaining it properly. So what this actually means is if you take this $50,000 loan, you've got $2,500 in loan interest. What would happen here, here's the $2,500, is you would divide that by 365 days. Remember that the industry uses what term? It accrues daily at annual simple interest. So when we divide it by 365 days, that's the amount we have, $6 and call it 85 cents, that would accrue each day. So for example, day one, or day zero we could call it, your loan balance is $50,000. The next day, if you don't pay that loan off immediately, what would happen? I would have $50,000 and $6, $50,006 and 85 cents. If I don't do anything for another day, another $6.85 is added. So each day, $6.85 is added to the loan principal. That happens up until the policy anniversary date. So I am billed for any loan interest that has accrued over the course of the year on that anniversary date. Now, what's important to be aware of there is if I take a policy loan on my anniversary date, say it's $50,000, I take that $50K loan, over 12 months, what's going to happen? Well, it's going to accrue to $2,500. I have to pay that on the anniversary date. I don't have to, but it is typically in my best interest to do so. If I were to take a $50,000 loan 6 months prior to my anniversary date, what would happen? Well, interest would accrue up until my policy anniversary date. Whatever amount has accrued would then be due, which in this particular example, over 6 months would be how much? Cut that number in half, $1,250. Now, what I do also want to add is if you don't pay it, it does compound. So what would happen if we go back to the calculator here is I've got that $50,000 loan, 50K, at $2,500 of loan interest. Let's assume you don't pay it. So what will happen then is the policy will borrow from the cash value to cover the loan, or the loan interest, I should say, and now my balance is $52,500. Here's what's important to be aware of. The same cycle then repeats itself. Now my loan balance has accrued to $52,500. Take the same loan interest rate times 0.05, $26,250. You would divide that by 365 days, and that's the new amount that is added to your balance day in and day out. So it is always simple interest over the course of your policy year, and then if you do not pay the loan interest when it is due, it's added to your loan balance. How that works is that the policy borrows against itself to cover that actual loan interest bill. Now that can sometimes be confusing. You can always reach out to us and we'll be happy to discuss with you. You can always also rewind this video if that helps as well. So on that point, just to provide some visuals here, let's take the same example. You take this $50,000 loan. What happens is if you took it on day one on your anniversary date, so you've got a policy anniversary date of January 1st. You take a $50,000 loan on January 1st, January 1st of the next year, or call it December 31st, after a full 12 months, the loan interest would have accrued to $2,500. That assumes a $50,000 loan. Now, let's assume you took that loan, still the same date, January 1st, but now, over 6 months, you decide, hey, I sold a piece of property early, I came into a windfall of money, I can pay this loan off. What's my total loan payoff amount? Well, over 6 months, how much loan interest would have accrued? Half the amount, $1,250. So your loan payoff amount would be how much? This plus this, $51,250. Make sense? Interesting, isn't it, how it works? All the meanwhile, you're still earning that 6% dividend, or that's still being credited to your full cash value as if you had the full 100K. A nice feature, and we go through this in a lot of our videos on how policy loans work, is I like to see what a policy looks like if I just let it sit and grow, and then take that same model and see what's it look like when I borrow against it and don't pay it back, pay interest only. If I pay it back in full, then I see my cash value and death benefit fully restored to what it would have been as if I never touched it in the first place. Really, how companies continue to credit a dividend on your full cash value, even though you've borrowed against it, is that they are collateralizing your death benefit, which we cover that in other videos. So the last point I want to touch on here, hopefully this has been helpful, is that some companies bill in advance. So what this means, Guardian does this. Let's assume the same example, that you have a 5% loan interest bill, or loan interest rate. If you take that $50,000 loan, what'll happen is, let's again assume it's January 1st, day one of your policy anniversary date, is your day one balance on your statement or on your online portal would read $52,500. They bill everything up front. And some people hear that and say, ooh, I don't want that. It's confusing. And I think it's a little confusing too. But with that said, how it works is if you elect to make payments at any time prior to the anniversary date, you get a refund for any loan interest that was billed in advance. As an example, let's assume that you pay the loan off in full in 6 months. Even though they billed the $2,500 in advance, on your statement you see $52,500, when you go in your online portal, that's your loan balance. The loan payoff amount will actually read $51,250. So if I sent in to pay off my loan $52,500 because the company billed in advance, and that's what I saw in my online portal, I sent a check in for that amount. what would happen is they would actually give me a refund of the loan interest that was billed in advance, but it accounted for interest billed in advance all the way up until my policy anniversary date. And I'm paying it before my policy anniversary date. That's why they apply the refund. And again, that's if a company bills in advance. So I hope that you found this video helpful. If you did, please hit the like button, subscribe for more, reach out if you have any questions at all. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.